they're not only off to the races, they're in a hurry. They've been delayed for a year and a half in their trek to the upside by doubters, by scary Fed news, et cetera, et cetera. And they're saying it's over, we're going back up again. And this time they're going to make up for lost time. Because of the nature of the events that are going on out there, and I don't mean Russia, I'm talking about the monetary events, the culmination of massive mispricing of a certain asset category, primarily stocks, that when that comes undone, gold will drive much higher than a normal bull market. We don't know where that's going to be. I suspect, 8 to 10,000, that's easy. That's no big deal. But it could be something well beyond that because of the nature of the events that are going on the other side of asset categories.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson, and back with us today, one of our viewers' favorite guests, Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Good to be back.
It's great to have you, especially in these crazy times as we're seeing big moves in the metals markets. Your take on what we've been seeing recently with gold almost touching its all-time high and silver making quite a big move as well.
Well, the process, what's been going on in gold and silver since, well, actually the 2015 low. The low close in gold, monthly close, was in December 2015, 1,060. So in the next 5 years, it doubled in price. And if you stand back and look at it, there was no particular excuse, headline type event. In fact, for instance, the commodity explosion in prices we've seen really began in late 2020. That's where most commodities turned up and broke out by our metrics, Bloomberg Commodity Index, for example. So you really didn't even have, quote, commodity inflation sparking the gold move. Gold knew it was coming. I think what gold is fully aware of is, one, it's been money for thousands of years. Okay, so, you could have, if you were an alien and dropped onto the planet Earth 500 years ago and ended up in the darkest part of Africa or in a city in Europe, you would have found they knew what gold was. Okay, it was almost universal. It's been universal. Central banks creating paper that's worthless and not backed by anything but their promises. Money units that expand like a river flow. In fact, since 1959, M2 has gone up about double almost every decade in quantity. Recently, it's gone parabolic. That's not true with gold, nor with silver. Quantity increases every year, but minuscule. It's hard to find more of it. So it is the alternative that's always been there. And it senses, it's been around 3,000 years. S&P's been around 70 years. The central bank's been around just less than 100 years, the Federal Reserve. So these things are infantile institutions and metrics. But since 2009, since the Fed went into QEs and all the magic they could come up with, they have put the pedal to the floor and kept it there. You can get an M2 chart from the Federal Reserve of St. Louis. Just go online, check in, type in M2, Federal Reserve of St. Louis. Also check in and get a Fed funds rate chart. This is the cost of money as determined by the central bank. And you'll see over 40 years it is staircased down to the point where, it basically laying at theoretical zero for a dozen years. That naturally created a situation where investors put that paper somewhere to work, that river flow, and they happened to choose the stock market. In 2009, when the stock market was in the 600s, I'm talking S&P, okay, there was a good argument for it. It was beat off the page. It had dropped from 1570 to 668 or something. So it was cheap. It was a good buy. Okay, we go with that. We were bullish then too. But for it to extend a dozen years parabolically is unheard of. It is largely created by monetary policy, and that monetary policy ultimately can't drive it forever. We've learned over 100 years of stock market history that there are booms and busts largely based on monetary policy. When they come undone because they get priced too high for too long, smart money says, okay, it's been great, I'm out. I'm going to find something else. I want to move my money to something safe. The spigot continues by the central bank, but the investors don't put it where they want them, the Fed wants them to put it. And we think that's been going on now since the commodity upturn in late 2020. We argued that the commodities, which had been in a deep hole between 2016 and 2020, to where prices, when almost any commodity you look at, was just so low for so long, it's like a submerged beach ball, that finally investors would say, hey, I had enough of this one, I'm going to go to this one. So they started buying commodity stocks, oil stocks, fertilizer companies, you name it, they've gone parabolic. It's been a repricing of assets out of the expensive high price bubble into the asset categories that are depressed and have less risk and more reward. That's the perception. And they were right. More and more investors are now making that decision belatedly, but they're doing it. You can see it. You flip on CNBC and you now have talking heads actually favoring gold or favoring oil stocks, et cetera, et cetera. Therefore, no matter what the central bank does, and if they try to tighten, they're going to worsen the bubble break, the bubble that they created and is now coming unwound in phases, not in a crash type mode. Most bear markets and stocks do not begin with crashes. They're arm wrestling matches. They go down 10, 15%, rally 5, down 15, so no crashes. That's what we've been seeing since December, that same type of arm wrestling behavior with teasing rallies in between. But as it becomes more apparent to investors, asset managers, and to the Fed that, this thing's coming undone. And there are certain other asset categories adjacent to the stock market. High yield corporate debt's one. It's one that the Fed has outright bought. They bought ETFs. If in mid-2020 through middle of last year, they were big buyers of ETFs related to high yield corporate debt. They were also buyers of muni bonds to support state and local governments. Well, if you look at the charts of such ETFs as, let's say, HYG and JNK, those are high yield corporate debt ETFs, they're melting off the page. Fed can't stand that. Muni bond, MUB, is an ETF of muni bonds. Take a look at it. It's been leading the stock market down. These are asset categories that the central banks cannot allow, based upon their assumption of their duties, to go into meltdown, because they're just going to have to print more money to make state and local governments function, or help keep corporations from going under. So their talk about raising rates, look what gold has done in the face of that. You would think gold would sell off. Well, it did. In mid-June of last year, when they first announced the term tapering and even raising rates, you had 4 distinct sell-offs in gold from the 1800s down into the 1700s. Most of those sell-offs were redundant, meaning after you get the sell-off, they go right back up and then they sell it again, another Fed spokesman, et cetera, et cetera. And now we're at $2,000. And we actually made a new intraday high at 2078 the other day, $8 above the 2011 high. So it got up here despite the fact that the Fed doesn't want it up here, wants you to buy stocks, despite the threat of raising rates on you and therefore fighting inflation. Gold doesn't believe it, because I think what it knows is this, and that is that the bubble is breaking, the prior bubble of a dozen years. And if that comes unwound, the central bank will have to totally reverse policy in some sort of dance step posture, from tapering and raising rates to, we've got to be careful here. And in fact, we've noticed in a lot of speeches by current Fed governors and ex-Fed governors over the last week or so, especially, the word caution has been used, meaning we've got to be cautious about this rate rise. They were thinking, 0.5% on the first rate rise coming up next week. Now they're saying, oh, no, it's only a quarter, guaranteed. They may even regret that. And I think gold knows it, because if these other asset categories descend into breaking bubbles, the central banks will go back to panic mode again. And gold knows that, and it knows what that means to monetary policy wise and in terms of what the value of fiat money is. And so I think that's what's driving gold. It's not some specific instance of like Ukraine, for example. Oh, yes, Ukraine may exacerbate the situation by causing banking problems here or there and so forth. We all know about that. A lot of European banks have been sort of shin kicked by this action against Russia. But gold knows the ultimate outcome. It's a wise market. It's looking broadly. It's not looking at today's headlines. And we think it's just been reborn. We've been in a 1.5-year corrective process in gold from 2000 plus down to 2070 and 2020, down to 1673 in March of 21. So we had a good 20% correction and a lot of floundering in between. Silver had a good $8 correction from its size, 30 down to 22. They repeatedly banged it down to the 22 level, trying to get it rolling on the downside. There's multiple assaults on that level over the last 6 months, and they couldn't get it going, despite the Fed headlines. And now silver's traded up to 27.5 this week. We think that advance, when silver went through about 24.5, is where our trigger was pulled. We said, okay, the correction's over. We're now back in bull mode. What kind of bull mode are we talking about? Look at gold first. If you go back 45 years when gold was legalized in 75, 47 years. In fact, just before that, when gold was at 20, 30 bucks and then went to 200 in 1975, there have been 3 major bull markets in gold that each has created a multiple of 7 to 8-fold times the bear market price that preceded the bull market. Okay, 7 to 8-fold. Well, we made a low in 2015 at 1,050 something, intraday low. Well, you do the math. 7 to 8-fold, puts you up $8,000 or so. So we haven't even matched yet the normal logarithmic or ratio scale bull market that gold has produced 3 times in the last 40 years. So it's not like a big deal to make some statement that, well, gold could replicate those bull markets. But because of the nature of the events that are going on out there, and I don't mean Russia, I'm talking about the monetary events, the culmination of massive mispricing of a certain asset category, primarily stocks, that when that comes undone, gold will drive much higher than a normal bull market. We don't know where that's going to be. I suspect, 8 to 10,000, that's easy. That's no big deal. But it could be something well beyond that because of the nature of the events that are going on the other side of asset categories. And the collapse in certain institutions, both private and public, that will occur during that process. As for silver, we know that historically, if you go back again, that 4+ decades, and measure silver as a percent of the price of gold, you'll see that there were 4 distinct times in that 40+ years where silver price rose to at least 3% of the price of gold at that time. In fact, 2 of the times, one was 6.5% of the price of gold, another time it was at 4% plus, and 2 other times at 3% plus. Well, silver right now is just below 1.4% of the price of gold. So even if gold just stood still at 2,000 and silver said, okay, I'm going to just exhale and go up to the 3% level again, 5th time in 50 years, let's say, it'd be $60, just matching the old ratios. And if gold were 8,000, well, you do the math, it's a couple $100 for silver. So we measure not just the net trend of gold and silver and time their turns, which we now define as a resumption of the bull trend, but we also measure the relationship between the two via spread analysis, where we measure silver weekly or monthly against the price of gold. We also do momentum studies of that. Well, our momentum studies indicate to us that silver actually shifted to positive after multiple years of degradation. Between 2011 and 2016, silver lost value versus gold. It was not the place to be. But in that upturn in 2020, mid-2020, when silver went from the teens to $30 in about 6 weeks, the spread broke out. Meaning at that point, silver ratio to gold turned into a positive zigzag trend. Now, over the last year or so, silver has pulled back again in relation to gold, but it's still in a positive trend. In other words, that pullback is a downturn in an uptrend. Now, that upturn has resumed again. Just like the net trend of silver and gold just re-engaged over the last week or two, a couple weeks. Same with gold miners. The ratio of silver to gold has also turned back to clearly positive. We think that process of getting up to the normal 3%, let's say, is it underway again. So we favor, while the mama is gold, there's no question, we favor silver over gold on a ratio basis. We think it'll outperform handily over gold. And we think that the gold and silver miners, which as we know over the last year or so have really been psychologically punishing those who invested in the mining aspect of the metal sector. That has also shifted back to positive, where, for instance, we measure GDX, very popular ETF of gold and silver miners versus gold. That spread relationship has also shifted back to positive. So as gold is now resuming its trend, we favor silver and gold and silver miners over gold. I think it's going to be the place to be over the next year or two. And golly, we don't know how high it might go. Something off the page would not surprise us.
So it seems like, as you're mentioning, we're really just in the beginning stages of this bull market. Are there any price points, or can you reiterate for our viewers the signals that you've been seeing that really are saying that, yep, we're off to the races from here?
Well, we've broken through that level. Actually, last November, when gold rallied up into the 1800s, I think it got to 1870, I think was its peak, and it pulled back under 1800 again after that. But in that surge, what we call quarterly momentum, now annual momentum has been positive since 2016. We got bullish in February 2016. Gold was 1140. Nothing has changed. Okay. But quarterly momentum, when we measure price versus a 3-quarter moving average instead of a 3-year average, turned down in January of 2021 and built a bottoming action on momentum. Now, you don't see it on the price chart. That broke out to the upside in November, but there was a problem with that rally in gold. It surged, $100 up the upper 1800s. Silver did not agree. Silver went right up to our starting gate point, which looked very similar on the momentum charts to gold. It stopped. It didn't go through. And we wanted to see coincident behavior on their both echo each other. They didn't. But 2 weeks ago, silver broke through the structure. That happened to be at 24.44, if you want the exact number. Any trade up above there, we did it. And we surged $3 after that. Right now, we're about $2 above there. As far as what will excite the price crowd, one, gold has nipped out the old high of summer of 2020, which happened to be at 2070 was the price of gold, 2070. We nipped it out by $7. So gold's gotten back to its old high. But if you round it off to $100 increments, and a lot of people who keep point and figure charts, the X's and O type things, if you keep a $100 chart on gold, well, all we did is go back to 2000. We didn't hit 2100. So if we hit 2100, that's going to excite some price guys. They're going to say, yes, this is really credible. It really is above the summer 2020 high. For silver, if you'll take a weekly price chart of silver, the momentum's already broken out. Okay, so forget that. But price usually lags momentum. And if you look at a price chart, which is what most people do, and let's say a weekly, and plot just the weekly closes going back to 2020 rally high, you'll see there were 3 peaks from the summer 2020 through early 2021 that each ran up to around $28 to close a week out. Now, they had some trades that reached up to 30, but the high weekly close all during that cluster of peak weekly closes was $28.14. Okay. The high this past week so far has been near 27.50. So we're getting close. If you close silver above that 28, let's call it 28.15 or higher on a weekly close, that will clear all prior peak weekly price closes of the entire move. So that's a level that will no doubt begin to excite, belatedly, the price chart watchers, where they'll say, okay, now I believe again, So those are 2 levels to watch, 2100 gold and 28.15 weekly close for silver. These are price based numbers. And I think if you see that, you're going to start to get a more accelerated tone. In other words, we've been used to arm wrestling type action in gold and silver for the last year plus, where, you get a $20, $30 day in gold, up, down, that kind of stuff. And silver, you're lucky at $1 would be the most you'd see in any one day, and usually it's 30, 40 cent range. All of a sudden, lately, we've gotten, almost $2 range. So you're going to start to see a change in the tone and the behavior and the verticality of these markets to where get used to the fact you might start to see silver moving $5 a day, both up and down in the process of its advance. So we think the nature of these two markets is going to change both in direction back to the upside, but two, also in the tonal behavior and the speed at which they gain ground. There's another market out there that a lot of asset managers have used as an alternative to stocks, and that's been long-term government bonds, 30-year and 10-year notes, as a safe place to be. And we saw that back in 2020, where there were spikes in the bond market, upside, drops in yields, coincident with upside moves in gold, which indicated to us that asset managers were, in fact, looking for a safe place to be. That has not been occurring lately. T-bonds have been behaving generally weak, meaning higher yields, and also they don't seem to sustain their sharp rallies. Even though the stock market might be weak, the money that tries to go into T-bonds as an alternative isn't finding success there, which means what? It means of the two big alternatives, there's one that's starting to really shine, meaning the more money will begin to be focused in the gold-related sector. So that's another benefit for gold. Anyway, focus wide, we think the game is now on again. The pause of the last year and a half is over, and we're back into bull mode, except this time the bull mode should be more vertical.
And you mentioned how the volatility will increase as the prices move up, and it seems like we've already been seeing that the last couple of days. Gold, moved to 2070 and then back down below 2000 the next day. And so we've seen within a day or two, gold, the range is over $100. So is that a good sign that it means another sign that gold and silver are off to the races?
Yes, I think it's an indication that they're not only off to the races, they're in a hurry. They've been delayed for a year and a half in their trek to the upside by doubters, by scary Fed news, et cetera, et cetera. And they're saying it's over, we're going back up again. And this time they're going to make up for lost time. And quite often this occurs in bull markets where, the initial phase of the bull market might be at a certain angle of descent, and then it changes more vertical. And we think because of the nature of the external events, the other asset categories going the other way, and therefore spooking the central banks, this move will be more vertical and speedy for gold and silver. They will gain more ground more quickly than you expect. This is particularly upsetting for people who probably were shaken out of their positions over the last year or so. I think, prior to the explosion in GDX, it was at 16 and it went to 45 or so and pulled back to 28 repeatedly. Now it's 37, 38. But a lot of people got shaken out of their long mining positions. Well, the problem for them is, and also for people who weren't even participating in that sector, they're going to have to chase it now. The market's not going to gift them quiet pullbacks. You'll get sharp pullbacks, but they'll be at higher and higher and higher levels. And so it makes it tough for people to reposition or to initially position here. It was interesting the other day, too, by the way, you mentioned that gold, for instance, dropped $100 intraday from a high the other day to a low and so forth. It's rebounded since. But at the same time, if you look at a GDX chart, a daily, just the closes, I noticed that during that 3 days of turbulence in gold, and Monday, Tuesday, Wednesday, the GDX closes were tight-fisted sideways. It's like it's just sitting there, firm. Yeah, intraday stabs up and down, but the closes were all quite steady, and this is now a fourth day at the same tone. We've noticed in the last few weeks, in particular in the mining sector, that, and we suspect this is because of large asset managers, fund managers, big ones, are suddenly reallocating to this sector no doubt from the stock market, which they've become skeptical about. And when they reallocate to such a small sector as the gold miners, when they move money in, it causes jolts. And so you look at some of these gold miners, daily charts, for example, go back 2-3 weeks, you'll see thunderbolts, more astounding than what you see out of gold, for example. And we think that's evidence of large fund managers saying, I'm out of this, I'm into this. And, they're not going to get into that and then get out 2 days later. They're reallocating investment capital. And we think there'll be more and more of that, particularly as those markets continue to advance. The skeptics on the sideline will say, hey, where do I go? T-bonds aren't working anymore. They used to be an alternative to the stock market, just like gold was over the last couple of years. T-bonds and gold tended to move together, in fact. Up in price, drop in yields, gold went up. That's no longer true. So there's only one alternative left out there. That's the monetary metals and the miners related there too. So that kind of new entry into the market is going to cause a tonal difference that we're going to see, I think, in the metals and also in the miners.
Now we have a viewer's question for you here, and the question is essentially, it's from Daniel, and he's wanting to know regarding the relationship between gold miners and the price of gold. In your momentum analysis, which does it look like leads?
Obviously, gold led from the 2015 low, okay? But it's no longer leading. If you'll go back and look at the ratio of the price of the GDX, for example, in relation to gold, yes, it ebbs and flows, but it's in a positive trend direction now. It's rejoined upside. So the spread between GDX, gold miner ETF, or any others, measured against gold is now back into positive performance. So it'll look like the miners are now leading. In fact, they've lagged from time to time. But usually during the upside in a mature bull market, the miners will lead on a ratio basis, percentage basis. So they're definitely a place to be. So if gold's going to go from here to 8,000, let's say a normal bull market, 7 to 8-fold, the miners will beat that on a percent basis. And silver will beat that as well. So no, I don't think the miners lead. I think the miners follow. But when they follow, they're like a dog on a leash. They either run behind you or they run ahead of you. And when we're going up, sure enough, the miners re-engage to the upside and become tonally stronger than gold.
And do you believe that is going to be true for just select gold and silver miners? Or do you think the indexes like GDX and the silver ETF index, do you think those will outperform gold and silver as well?
Yeah, we don't look at the fundamentals of the miners, okay? We know they exist, just like any company. And within any sector, whether you're looking at the utilities sector or the tech sector, there's always outperformers in the sector and underperformers. And the same is true with the gold and silver miners. There's those symbols that are beating the GDX, and we try to, in our gold silver mining reports, once a month, we sift through the miners and measure them in relation to the index of the ETF to see which ones are trending better in a performance basis than GDX or trending worse. And we try to call them out and define who they are. But if you don't want to go to all that trouble, probably the better thing to do is simply buy the ETFs. And you're buying a basket, and yes, you'll have some symbols in there that perhaps are underperforming GDX. They will by nature, and some that are beating it. And in recent days, for example, it's very interesting that Barrick Gold, primarily in Toronto, ABX.TO, and there's GOLD in the United States, and Newmont, two of the biggest gold miners in the world, are beating GDX. That tells us that why are the big blue chip symbols of the sector beating it? I think it's another further evidence that large asset managers are buying into the sector, and they're not buying penny stocks, they're buying the big blue chips, and that's why they're outperforming. Anyway, that's my thought on that.
All right. Well, Michael, thank you so much for your time today. If our viewers are interested in subscribing to your newsletter, they can go to OliverMSA.com. Did you want to share with us a little bit about that and any last thoughts you had?
Well, MSA, or Momentum Structural Analysis, we've been around since 1992, so 30 years. Okay, we have a different mode of technical analysis. We treat price as a secondary and our momentum metrics as a primary. And we don't do momentum in the same way that is commonly done on your quote screen, like MACD and these various indicators that are free on your screen. We look for structure of momentum action, trend structure. Just like price guys look for price structure to break out. We find that momentum tends to lead price. So we get an early warning most of the time that something's about to change, either up or down. And we think we offer, to that extent, a better product in terms of timing. Our primary focus is not short term. It's to get you into a market to catch major moves. So that's our range of focus.
All right, Michael, once again, thank you so much for your time, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.